Equity markets. Good morning, Agam.
Good morning, Samina. No worries here. Well, we continue. It seems like we're going to hit 26,000 as well today.
Anytime soon, from the get-go, maybe this morning. So it seems like a good possibility that the Nifty may hit 26,000 from the word go this morning. A quick check on implied Nifty before we take you through all the global action that we're tracking this morning, and it doesn't seem to be there on implied Nifty just yet. You're about 60 points short, 60 to 70 points short of 26,000 in yesterday's close. So that level becomes extremely important, at least sentimentally, for this trade. Bulls have been on a roll, and that's very evident, not just locally, but globally as well. A quick check of what happened in Asia this morning. Asian markets were trading flat. Japan's been on a good roll for the last couple of days. It's played catch up. But what's played serious catch up is what's happening in Hong Kong. That market is now up 2%. Shanghai, which was down about 1%, then traded flat, now trading with a gain of 0.7%. Well, it's the People Banks of China that's announced it will reduce the reserve requirement ratio by 50 basis points. Australia's central bank decision on rates is also expected anytime now. Well, the PBOC will cut its reserve requirement ratio for banks by 50 bips, although it hasn't provided specific timelines. It's also announced it would cut the 7-day reverse repurchase rate from 1.7 to 1.5. There are a slew of measures that the Central Bank of China has been announcing. Yesterday as well, there was a cut on the 14-day reverse repo, along with infusing over $10 billion into the system. This morning, of course, another measure in order to help the economic setup in China. Well, that's, of course, what's happening, and the market's getting excited about that. Chinese equity are not doing too badly on back of that easing cycle that's indicated by the Central Bank of China. Well, moving on from China, what's happening across the rest of the world? So you have a decent picture across Asian equity markets. Wall Street as well managed to end marginally higher. It was a volatile day of trade on Wall Street, but finally the Dow, the Nasdaq and the S&P 500 all went home with marginal gains, carrying forward the rally from last week. The Dow and the S&P 500, in fact, closed at their record levels. Well, what's happened is there was some economic data that came in. U.S. business activity is steady in September. At least that's what the economic parameters have indicated. Average U.S. prices for goods and services have jumped faster than expected in 6 months, once again reigniting fears of inflation, but clearly on the back burner for now. All eyes will remain on August consumer confidence data that's expected later on today on Wall Street, and personal consumption expenditure, which is an important data point that the Fed watches out for, is expected towards the end of the week, which is on Friday. The US dollar index remains flat. Small cap index continues to see aggressive buying emerging from traders that are seeking value in US equities. Well, away from equities, let's take a check of what's happening in commodities. Across Asia as well, commodities are doing decently well on back of China's rate action. But more importantly, it's oil that you want to track. It's had a good run last week, continues to gain. Remember the geopolitical risk with Israel attacking Lebanon now. Fears are spreading that this attack could spread to countries like Iran, which could then impact the supply of crude coming in. On the downside, though, a slowing economy in China, activity slowing in Europe, continue to keep the tap on crude prices. Gold, on the other hand, continues to make new records. A Fed rate cut and then rising geopolitical risk is a perfect cocktail for gold prices to move higher. So that's what we have globally. The setup, not too bad this morning. It seems like we could be heading to new highs as early as 9:15 this morning. All eyes will remain on how the bulls deal with that. Well, a quick recap before I hand it over to Agam for what happened in terms of activity on D Street in trade. It was a pleasant day, and that's probably the best way to put it. The Nifty, of course, managed to eke out sharp gains in yesterday's day of trade. Well, it was a morning, in fact, a day that was volatile, but all in all, it looked like a session that markets were excited about. You had a number of sectors that did well. Broader markets also had some activity that they picked up. But all in all, as we gear up this morning, Agam, what do we have?
Well, 26,000 clearly now, just about within touching distance for the Nifty. What we're watching out for is that while 26,000 is still around, we're looking at a lot of writing around that call, that specific call. which means that should we see the Nifty move above that mark and sustain above that mark, that will lead to a lot of unwinding of those specific calls written, and that could perhaps further exacerbate the move upwards on an intraday basis. Little later on, well, we may see a little bit of profit taking. We cannot rule that out. But this, as a technical factor, is most likely to play out should we see strength in the first 1 hour of trade. Can't rule out more, based on the follow-up. Now, at the moment, your technical parameters on the higher end won't matter much because Nifty is in uncharted territory. And on the base end, we are looking at a support building up around the zone of 25,500 and 25,600. What is really playing in favor of Indian markets is that institutions, both foreign institutions as well as domestic institutions, are coming together and buying into Indian equities, and that always bodes well. As far as the Bank Nifty is concerned, again, we're at a little bit of a fulcrum when it comes to 54,000, but the positive is that 55,000 is on the horizon now. And for now, at least as far as the price action is concerned, that continues to remain very, very encouraging, Samina.
Indeed, and it looks good in terms of the F&O setup as well, and that's how Nifty Bank has played out. Managed to go home with gains in trade yesterday. One space, though, that has been seeing profit taking over the last few days has been the IT pack. Nifty IT continues to reel under pressure. In fact, even in yesterday's day of trade, when most sectors ended the day on a positive note, IT went home with a cut of 0.5%. Pharma, which was soft last week on back of profit taking, bounced back quite well in trade yesterday. What you also want to remember is PSU banks. Now, they've been in hiding for the last couple of days, and the rally across Bank Nifty was largely led by private sector banks like ICICI Bank, Kotak and an HDFC Bank. But yesterday, the day belonged to the PSU banks. From an SBI to a Bank of Baroda to a Canara Bank, all those counters have gone home with significant gains. We are about, what we did see is about 350 stocks that hit a 52-week high on the BSE. What did though stand out for me is that while the markets had such a steady day of trade, well in control of the bulls, there was not a moment that we dipped into negative territory yesterday. It's the VIX that has actually jumped up quite significantly yesterday. The VIX was up nearly 8%. Now, this could mean some sort of uncertainty and discomfort that may come up for the bulls. I think, Agam, the other big trigger, which may not be local in nature, is the geopolitical stress right now.
Yeah.
With Israel and Lebanon finally seeming like they have, of course, there has been tension between the two countries.
Yeah.
The fear that this could potentially spread to Iran as well could keep global equities or risk-on trade move into risk-off for some time.
Absolutely. So, and that clearly will have some implications not only on crude, which will perhaps, of course, edge higher, but gold, which has been for some reason, it's gained traction, has come back into the imagination of a lot of investors over the last 6 months. And in fact, people are taking this very, very seriously, not just gold, but silver as well. So we are looking at very, very, impressive returns given to us by these precious metals. In fact, to a certain extent, we also understand that silver is yet to catch up with the kind of moves that the gold has made. Of course, gold continues to make record highs as well on a daily basis. And not to say the dollar index is an interesting one, and it's going to continue to be an interesting one because not only on account of the kind of traction that we've seen in the commodity space, but the way bonds and bond yields will move, given that we've already seen that big 50 basis points cut from the Federal Reserve, and that of course will clearly have an implication on the dollar index as well, which hasn't exactly been very, very strong. It's well off its life highs, but that's something to keep an eye on about how these will pan out going forward.
One thing as well, Agam, that stands out for me is that September historically has been a weak month for global equities.
Yeah.
I think this time around we could be setting ourselves to defy that, and you're seeing also very healthy rollover that's taking place on the index for October. And remember, this is going to be the last week of lull in some sense, because from the start of October, earnings season as well kicks off. But all in all, it looks like a good start. The VIX is unfortunately higher, but the bias remains on the long side. DIs and FIs both aggressively bought in terms of trade yesterday. A couple of sectors you want to continue tracking will be Bank Nifty, will be oil and gas, will of course be pharma, and whether or not IT sees a bounce back is what traders would also keep an eye on. Well, in terms of stocks, we've got a whole bunch of counters that we should be tracking. But just before we go into that, a quick one, Agam, I don't know whether you've studied the SEBI note on the money that traders are losing in the F&O space. You want to just quickly walk us through what that means, and then of course we can go into stocks?
Yeah, I will come to that, but well, in general, the findings of that the report are not not very surprising, because we've already had the SEBI suggest the kind of traction that we've seen. Firstly, is that we still have about 9 out of 10 participants out there who are losing money, but 93% to be precise, because so it's a little more than 9 out of 10. But what is also more alarming is that it's the loss-making traders. They continue to make bets in the options market, and they continue to place many positions despite being in losses. And on an average, we're looking at a nearly 2 lakh rupees loss per trader. And this, of course, is a study across 2 years, not just 1 year. And the top 3.5% of the loss makers have averaged about 28 lakhs. So it is quite something. And only 1% have earned profits over 1 lakh after costs, that is. So, a lot of these statistics are very, very alarming. But what is also perhaps a little bit more perplexing is that a lot of these traders continue to trade into options and derivatives despite the fact that they continue to remain loss making. So that's something that that's important to highlight as far as SEBI is concerned. And the financialization of savings has been a key metric that, including the SEBI chairperson, who has been pointing out the fact that there will be relatively less should this trend continue, and that perhaps will be at the forefront of on the minds of many.
Well, that of course is one piece of it, but let's move on to stocks very quickly and take a check of what will be or should be on your radar this morning. A whole bunch of counters to track. PNB on top of the list. Remember, the recent wave has been about fundraising and promoter stake sales. In this one, it's PNB now that's looking to raise funds to the tune of 7,500 crores via QIP at a floor price of 109.16. It's at a 5% discount. The stock went home with gains of nearly 2.5% yesterday, keeping in line with the PSU Bank. A 5% discount to yesterday's close. It seems like the supply could get lapped up in the counter. Usually on a fundraise plans, while negative, has in the recent past, stocks have been reacting positively, largely on back of how easily the supply gets picked up. Power grid, very important development on power grid. Now, whether or not this is going to move the stock is unlikely, but should mention that they've emerged as a successful bidder for the Khavda project. The Khavda project is to establish interstate transmission system. The other two that I have on my list is GR Infra, small company but big news flow. They've emerged as the lowest bidder for 900 crores of the Nagpur metro construction work, while BGR Energy, on the other hand, the Chennai Water Board has terminated a 440 crore order for them. Now, this is going to be negative news, and the stock will be seeing some selling pressure in the early hours on back of that order loss. Another one that I quickly want to talk about on block deal is VIP. Vijay Kedia has bought a significant stake in VIP, 0.5% stake to be precise, yesterday, and the stock, as you can see, was up 12% in trade. Agam.
Well, in terms of the list, I have Coal India right at the top of my list, where it has in fact signed a JV with Rajasthan Rajya Vidyut Utpadan Nigam, and this is a 74-26% JV, and JV is for 2 into 800 megawatt brownfield thermal project. it could potentially be a positive for Coal India going forward. Well, moving on, we also have Reliance Power, which is in focus. Now, as far as Reliance Power is concerned, and it's the ADAG group which actually has gained quite a bit. Over the past few days, we've had Reliance Infra. Now it's Reliance Power's turn, where it seems like it's raised about 1,525 odd crores via preferential issue. Promoter Reliance Infra has raised stake by around 600 crores at the moment, and this is to enhance capital to support renewable energy plans. So very, very interesting. And finally, we also have an MK note, and they've initiated coverage on GMR Power. Now, they say that they've initiated a buy rating with a price target of about 180 rupees per share. And, well, they are also saying that the numerous optionalities which prop up based on the bull case target, as much as could potentially go to around 205 rupees per share. There's a core thermal asset nearing optimal performance when it comes to your coal taps, and we are also looking at several other factors which are playing in favor as far as MK is concerned. But we move forward and talk about a handful of brokerage notes this morning, and right at the top, well, we can consider perhaps Motilal Oswal, who has actually initiated coverage on the entire power sector. We have Mihika, who's joining us to give us an update on the same. Mihika, over to you.
Yes. Good morning, Agam. So they have initiated coverage on the Indian power sector with a buy rating on Power Grid, JSW Energy and Tata Power. They expect Power Grid, JSW Energy and Tata Power to have the highest upside in the range of 16 to 24%, while they maintain a neutral in NTPC and IEX, with IEX having a 5% downside. Now, Power Grid could be the bellwether play on the 2 lakh crore transmission opportunity, whereas JSW Energy could key differentiators in execution, asset turnaround, as well as robust balance sheet. And they have said that Tata Power the lower earnings volatility could give scope for a re-rating. In terms of view on the overall sector, well, the investment opportunity lies in 40 lakh crore rupees over the next decade, with generation, transmission, and smart metering accounting for maximum of the investment opportunity. They expect the power consumption to also grow at a 7% CAGR over the next decade, and EVs and data centers to drive 1/3 of power demand growth by 2035.
All right, Megha, thank you so much for getting us that update on the power sector. Of course, the other one on the radar, which I've just mentioned, was GMR Power, which was initiated by MK when they're looking at about a 20% upside from current market levels. But with that, let's actually take stock of some of these companies in the utility space. Of course, we had plenty of traction when it comes to NTPC. Moving on, we have, and that's of course largely on account of the green energy IPO that we're keeping an eye on and tracking. We've had positive traction in Tata Power of late. In fact, yesterday was a day where we did in fact see a little bit of an up move there. But that, of course, is your Motilal Oswal chart when it comes to your coverage. They're neutral on NTPC and IEX. IEX, of course, has its own set of challenges, even though the stock has done very well recently. Power Grid, JSW Energy, and Tata Power are three companies where Motilal Oswal is looking favorably. So that's something that we need to bear in mind. But with that, let's shift focus to the telecommunications space. Now, we've been talking quite a bit about how things are faring, how things are panning out for the entire sector. There are pros and cons, and more often than not, Vodafone Idea keeps propping up as far as the news flow is concerned, that it's perhaps been the most sensitive to news flow as well. Well, yesterday was a day of trade where it did have a little bit of a relief, if I can call it that, because there was positive news flow, and on account of that, we saw a little bit of buying return to Vodafone Idea. But let's take this forward in conversation with Balaji Subramaniam. He's the Vice President of Research at IFL Securities, who is joining us right now. Balaji, good morning. Thank you so much for joining in and taking the time out. First, let me come to the issue with Vodafone Idea. With the update from the Supreme Court around the AGR, and then, of course, yesterday we have a small positive update. But in the long run, I'd reckon that the factor which will weigh the most on Vodafone Idea is the AGR dues. What is your assessment on this particular stock as of now?
Good morning. Thanks for having me on the show. As far as Vodafone Idea's recovery is concerned, there were a number of things that needed to fall into place. The first thing was the fundraise. On that count, we are somewhere halfway there, because the reason I say we are halfway there is because while the company has managed to raise equity funding to the tune of 24,000 crores, they are in the middle of the debt raise, which would be another 25,000 crores. And on top of that, they are also looking at non-fund based exposure of another 10,000 crores. So we are somewhere there as far as the progress on the fundraising is concerned. The second aspect is the tariff increase, or rather, multiple rounds of tariff increase. When I say multiple rounds, I look at 2 or 3 rounds of tariff increase. There, the good news is that we have had 1 round of tariff increase as expected. So there, things seem to be progressing along expected lines. The third one was the potential relief on the AGR dues. So the total AGR dues of the company are to the tune of 70,000 crore rupees. And the hope was that if the Supreme Court admitted the curative petition and allowed the DOT to rectify the calculation errors, that would have resulted in about 50% relief approximately. But that doesn't look like coming through, at least as far as the Supreme Court is concerned. I think we have heard the last word from them. Yesterday on the investor call by the Vodafone management, the management was alluding to a number of mechanisms, stroke actions which the government can take from their side. Now, the company did not go into the specifics as to what exactly the government can do, but at least they seemed hopeful that something positive will come out of that. But we'll have to see, because I don't know how much leeway the government has got, because the Supreme Court in its original AGR order had clearly said that there can be no reassessment of the dues. So my sense is that something like the extension of a moratorium, which will give some sort of a cash flow relief for Vodafone Idea for the next 2 or 3 or 4 years, depending on what is the moratorium extension from the government. I would think, that is something which is under the government's control. And of course, the other option would be for the government to convert more of these dues into equity. Of course, the trade-off here is that while that would stabilize Vodafone Idea as a company, that would also mean that the existing shareholders stand to get diluted significantly. So my overall take is that the company should keep operating as a going concern, but the big challenge is, the potential dilution which the existing shareholders will end up seeing at some point in time.
Right. Balaji, come in on the implications for Indus Tower as well, right? Because, prima facie, it may be that Indus Tower could potentially be a beneficiary, but that isn't the case. And in fact, that's also taken a hit here because we're expecting more gains from Airtel now, even as it expands. What is your view for Indus Tower overall, and how does this AGR thing play out for Indus Towers?
As far as Indus Towers is concerned, it would be a play on Vodafone's proposed network expansion. So all this fundraise is entirely going towards network expansion, be it in the form of 4G coverage, 5G coverage, 4G capacity. So all these are going to go towards network build-outs. So as I said, almost 50% of the funds required for the network rollout is already in the bag. The remaining 50% is where there is some degree of uncertainty, because as I said earlier, the company is in the midst of raising debt funds. And yesterday on the call, the management was categorical in saying that the AGR verdict should not result in a setback in the debt raising process. And they went on to add that the debt funding should be completed in the next 7 to 8 weeks. So if the debt raising part goes without any hitches, then I would believe that Indus should do well, because and Vodafone also said that the key priority in terms of their capex program would be the expansion of 4G coverage, and that would mean extra tenancies on Indus's existing towers, which would be a significant positive for Indus. But of course, the key uncertainty here is that if the fundraising of Vodafone Idea gets delayed, then that uncertainty can weigh on Indus's stock, because one, that would mean that whatever 5,000 crores overdues that Indus has to get from Vodafone Idea, that may not be realized soon. And number two, if Vodafone Idea were to go ahead with a curtailed capex program, then that would mean that the tenancy increase for Indus may not be as high as what everyone was envisaging maybe a year back, maybe a week back, before we heard the AGR petition outcome.
Balaji, not sure if you already mentioned this, but if the market is expecting another tariff hike over the next 1 to 2 years to the tune of 15 to 20%, what will it do for the other players beyond Vodafone? And I ask you this because Bharti Airtel has already gained significantly in terms of stock performance. On anticipation of another tariff hike, as the stock performance predicts, what does an investor do with those stocks?
So my sense is that even Airtel, the Bharti Airtel stock at 1500 was probably factoring in another round of tariff hike. And now the stock has been on a tear, especially in the last 1 month, where it has gone up by nearly 20%. That's a lot of stock price appreciation for a large cap stock for Bharti Airtel. So my sense is that the street is probably now factoring in another 15 to 20% tariff hike, maybe 1 more year down the line. And so I think so basically we need to have 3 rounds of tariff hike, including the one which was announced in July this year. So, if we have 2-3 rounds of tariff hike, then we are looking at Airtel probably hitting the 350 rupee mark in terms of ARPU by FY27, FY28. And that would mean that maybe we have another 10% upside from the current stock price levels at Airtel. So my take is that a lot of the positive news is already in the price. Of course, this also has to be looked at from the overall market perspective, where the market itself has broader market itself has rallied quite a bit. And so that also so basically the point I'm trying to make is that the liquidity conditions can also make the stocks can make the stocks rally well ahead of even what the fundamentals would suggest.
Balaji, before we wrap this conversation up, like you said, some of that anticipated good news is already in the price, but for a new investor who wants exposure to the telecom sector, what would your pecking order be?
So the safest bet would be Bharti Airtel and Hexacom, because here there are no conditionalities like, if Vodafone Idea raises funds, then, the benefit is X percent, Y percent. So for someone who is in there for the longer dig, I would be positive on both Hexacom and then Bharti Airtel. Then Indus also will be a good pick. Actually, it would be a good way to bet on Vodafone's recovery, because even if Vodafone is unable to raise equity funds, the absolute downside after the correction for Indus is not that high. While Vodafone Idea would be a high beta bet. So if there are two more rounds of tariff hike and Vodafone Idea manages to raise debt funding, then the upside can be pretty substantial at about 50% plus. But if some of these scenarios don't pan out the way the company would want to, then the downside also can be substantial.
Okay, Balaji, we leave it at that. Thank you so much for joining us and giving us your take on the entire sector and how investors can, in fact, go about well, dealing with some of these telecom names. But with the flood of IPOs continues, and well, today we have 3 listings on the bourses, and well, Samina is going to give us an update on what we can expect as far as the 3 debutants concerned today. Samina, over to you.
It's going to be a very, very busy morning, Agam. 3 listings expected. 2 out of the 3 should be getting a bumper opening. 1, unfortunately, may be a little subdued. I'll start with the subdued one and then move on to the exciting ones that are lined up. Western Carriers, this was an IPO that opened for subscription last week. It was about a 493 crore IPO. They managed to successfully raise about 148 crores through anchor investors. The price band, like it reflects, is 163 to 172. They were well subscribed to the tune of 30 times, which in these days and these times may not be as great as what we've seen with some other listings. A bunch of marquee investors, even though most of them were local, not too many global marquee investors joined the gang in terms of investing into Western Carriers. But the likes of Kotak Life Insurance, Motilal Nippon, to name a few, allocated some of their funds to Western Carriers. This one was expected to debut quite high, but for now what I'm expecting is a 10 rupees premium, 10 to 15 rupees premium to the subscription upper band price, which is 173. So best case scenario is 193 rupees. On the lower side, we should be getting a start somewhere close to 183 rupees on Western Carriers. Well, what does Western Carriers do? It is India's top private multimodal rail-focused asset-light logistic company. It has about 1,647 customers across various sectors. Their key clients include the likes of Tata Steel, Hindalco, Vedanta, HUL, Coal India, Cipla, to name a few. 163 crores of the funds that will be raised will be used to repay some part of their debt. 152 crores will be used to purchase commercial vehicles, shipping containers and reach stackers, with the remainder being allocated for corporate needs. A couple of risks on Western Carriers. While the valuations don't seem too bad, it's high competition and they depend on a bunch of key clients, so any loss of those clients could impact the company's top line. There are also sectoral risk, and the company does have a high debt model. So, Agam, I'm going to toss it back to you on F&O if you don't mind, and come back on the other 2 in a minute.
Yes, absolutely. So as far as the F&O's the picture is concerned, what we're actually keeping an eye on is the Nifty. Well, we've spoken about the fact that 26,000 is on the anvil right now, and that is perhaps going to be an important level to watch out for today. Now, we are keeping an eye on the way futures are panning out. Sure enough, the September futures will see a decline, but that's also because we are in expiry week. But we have seen that 0.6% up move as far as the Nifty 50 is concerned. Moving on, as far as the Bank Nifty goes, again, a lot of strength coming in. And while we have unwinding here as well on account of expiration week, we are also looking at a 0.6% advance for the Bank Nifty as well. 54,000 now becomes a little bit of a fulcrum, a pivot point around which we are expecting the Bank Nifty to move. But of course, Bank Nifty is also in uncharted territory at the moment, as is the case for the Nifty. So, well, that's going to be the other important factor to keep an eye on. Moving on, we are talking about the options market. Well, we are seeing at least as far as the Nifty is concerned, a little bit of resistance around 26,000. A lot of calls written there. But should we see the Nifty move about 26,000 and sustain there for the first one and a half hours of trade, you never know. You may actually see a lot of unwinding as far as those specific calls are concerned, and further exacerbating the up move as far as the Nifty goes. And on the lower end, we continue to see that base building around to 25,500, 25,600 in terms of the kind of writing of puts that we are seeing in. And moving on, as far as the Bank Nifty is concerned, again, 54,000 remains a pivot point, and that's something that we're going to continue to keep an eye on as far as, the traction for the Bank Nifty goes. But Samina, handing it back over to you in terms of what else is in store today.
Yeah, two big ones. So Western Carriers, like I said, is going to get a subdued start. But you know where you're going to find the excitement? It's going to be on Arcade Developers and Northern Arc. Now, Arcade Developers is an interesting one. They also had a small, semi-sized issue that came up, which is about 410 crores. They raised about 122 crores through anchors. Their issue price was in the band of 121 to 128 rupees a share, but they were very well subscribed, about 107 times subscription on Arcade Developers. Well, let's take you through who the big investors were. And this one had some very solid international players that came in. Societe Generale, to name a few, Saint Capital Fund and Alpha Investment were the global anchors that came in to Arcade Developers. The listing is expected to be at a significant premium to the tune of 60 to 65%. So expect the stock to see a pretty significant gap up, and there's a good chance it may build on it post-listing as well. Well, who is Arcade Developers? They're a Mumbai-based real estate company. They work on new projects and also work on redeveloping existing or old projects. So far, they've done about 1,040 residential units. They've sold 792 residential units between 2017 and the first quarter of 2023. The IPO valuation also looks rather competitive, so there's nothing too concerning in terms of the valuation or the pricing or the projects or the business model that they're currently in. A couple of risks that you want to keep in mind when you invest in Arcade Developers. So while the valuations seem compelling, there are some ongoing litigations for the company, so that could be a little bit of a sword hanging for Arcade Developers. Costs are also rising, and third-party contractors is who they work with. So a lot of the work they do is usually outsourced. Dependency on that could, of course, impact the operation performance of Arcade Developers. Raw materials also a concern, and the funds that they're raising will be used to repay debt and acquire some new land. So that, of course, is what you want to watch out for. But all in all, this one's a solidly oversubscribed subscription. 60 to 65% premium on listing, and also very well priced. So those are the three factors you want to keep in mind. Well, the other one that I have is Northern Arc. Now, this one got a lot of attention because it's an NBFC, and we all saw what happened with Bajaj Housing Finance. This was a relatively large-sized IPO, 777 crores. 230 odd crores was raised through anchor investors. The issue price was in the range of 249 to 263. Again, very healthy subscription, 110 times oversubscription is what we saw on Northern Arc. Amongst its investors, it had a whole host of local and global players who came in and allocated funds, from the likes of an SBI General to Reliance General to Goldman Sachs Singapore, who's actually been very active in the primary markets for its clients. Saw some allocations being made to Northern Arc. Well, this one should be listing at a premium of 50 to 55%. So on a good day, you may see the stock open up with a premium of 55%, but otherwise 45.50 cannot be ruled out. An expected listing price of 407 is what the street is eyeing. Well, who is Northern Arc? One, it's a Chennai-based NBFC company. They provide credit to the lower strata or the underserved households in the country. They either do it directly or indirectly through originator partners. Their revenues have grown significantly, and it's a well sort of growing industry. 45% up is what we've seen their revenues grow. Profitability also is up significantly by about 30 odd percent. A few risks you want to keep in mind for Northern Arc. All in all, it's a niche player. It's well capitalized. The funds that it's raising will also be used to shore up its capital base. But the fact remains that they've had a little bit of a problem with cash flow. So the cash flow has been negative, which could be a negative for the counter. And also they have a fairly high debt to equity ratio. So you want to keep that in mind. Of course, after this fundraise, that may improve because they would look to repay some of the debt as well. So all in all, Northern Arc looking to get well subscribed, 50 to 60% gap up, and Arcade Developers is 60% gap up. Western Carriers subdued, 5 to 10%. Agam is what I'd be guessing.
Absolutely. Well, plenty of counters out there to keep an eye on. Of course, as far as debuts are concerned on the large street, we'll be keeping an eye on those IPOs and how they list. But shifting focus back to the futures and options space, we now have Akshay P. Bhagwat. He's a senior VP at GM Financial who's joining us on the show right now. Akshay, good morning. Thanks for taking the time out. Akshay, what's the first stock on your radar? I believe you are playing a spread here. What are you tracking and why?
Yeah, good morning, Agam. Well, I'm taking a dark horse bet here in the private mid-cap banking space. It is a bull call spread on IDFC First Bank. So my thought is that IDFC First Bank is in a process of possible accumulation at the current zone, and there is a good chance that from the current market prices, the stock may rebound very strongly. So for that, I'm devising a bull call spread in IDFC First Bank, where I would suggest to buy the at the money call and sell out of the money 77 call strike. Roughly, the expectation is that if the stock moves upside to around 77, 78 for the October series, I am expecting a target potential of around 13,500. And as a risk management, I will play a stop loss of 7,200 on this trade.
All right, Akshay, so that's as far as IDFC is concerned. What's the other stock on your radar that you have this morning?
Yeah, so the first stock was IDFC, and I'm expecting Nifty to play out positively. So here I will be looking at HDFC AMC, which has been consolidating in the last 4 weeks in a very tight range. And the expectation is that yesterday's trade did see some strong long additions in the October series, and this stock is just waiting for a strong momentum upside tick. So here my trade is to go for a simple vanilla buy call option for the October expiry. That's the 31st October expiry. The strike will be 4,500, and roughly the expectation is that with a stop loss of 75, the stock should move above the levels of 200 for the October month. So roughly looking at the lot size, my expectation is that your risk will be around 7,500 in this strategy, and you can make around 13 to 14,000 going by the target and the stop loss in this counter.
Right. Just one quick question before we let you go. And we've already talked about your stock ideas that you like. Anything on real estate right now? Akshay, you know, we've seen so much activity on stocks like Godrej Properties, DLF, and I think it was a unanimous call across the board on stocks like DLF and Godrej Properties yesterday. Any trading strategies here? Fresh longs could be initiated, you think, today?
Absolutely, it was a day completely for the real estate pack, and here, you know, majority of them had their fair share of move as far as the short-term trading goes, but more is to come going by the strong rollovers which I see in this sector. And specifically, if I were to name a stock in this, it is Oberoi Realty, which closed around 1899 odd levels yesterday. So a very strong setup. It is getting past its prior swing high at 1875. It's been a strong and gentle uptick as I see in the last 4 to 5 sessions. Now the momentum will strongly get in the stock, which can see the stock getting past the levels of 2,000 very soon. So position yourself on the long side in Oberoi Realty. Reality space has just begun its momentum, and Oberoi Realty is one of the best stock picks in this space.
Oberoi Realty is what Akshay likes. The stock was up 2.5%, probably more room to go on this one, given that some of its industry peers actually had a stronger trade in yesterday's session. Thank you, Akshay. Always great having you on the show. Moving on from there, a quick check on implied Nifty before we go across to my colleague Vishwanathan. Implied Nifty is indicating to a gap up, but the gap up doesn't look as wide as it was at the start of the show. So flat to high, slightly higher start is what we're expecting, while all eyes will remain on 26,000. For now, it doesn't seem like it's going to be a given at the get-go this morning. Well, moving on from the Nifty to the NDTV, to an NDTV profit exclusive, sources to profit say that HDFC Bank is looking to sell 60 to 70,000 crore rupees worth of assets in the next few quarters. My colleague Vishwanathan Nair joins in with more on this. Vishy, what are your sources saying?
So what HDFC Bank is looking to do is essentially manage its credit deposit ratio. Now, of course, we know that after the merger with HDFC Limited, HDFC Bank's advances rose higher than the deposits. Currently, the credit deposit ratio is about 105%, and that's an unsustainable number as far as the bank is concerned. So what the bank is looking to do is offload some of these assets into the market using various instruments, specifically the pass-through certificates. The kind of loans that will be on sale will be mortgages mortgages as well as auto loans that are there on the bank's portfolio. These will be sold off to certain investors who will then ensure that there is free liquidity available with the bank. And for investors to come in, HDFC Bank is offering about 40 to 50 basis points higher than the contracted rate of these loans, of these underlying loans. So essentially that makes it a little bit of a sweeter deal for the investors to come in and buy. There are only 2 or 3 options that banks have to reduce their credit deposit ratio, the most important of which is to cut down on loan growth. And considering that the kind of bank HDFC Bank is, it cannot go out and cut down loan growth, and that's primarily why it's looking to offload these sales. In September, already about 9,000 odd crore worth of auto loans are on sale, and the bank is looking to close that deal before the quarter ends. And just like that, approximately a similar number will be sold in the coming quarters as well, each individual quarter. So that adds up to about 70,000 odd crore.
This is a big one, Vishy. We'll see how things play out when the counter opens up for trade. Yeah, the last few days, of course, HDFC Bank has been on the buy side. And the expectation, the hope of most bulls is that HDFC finally, after 5 years of underperformance, at least plays catch up with Bank Nifty. This could be an important development on that front. Well, let's now go across to all the stocks, as always, on our watch list that we are tracking. PNB, big fundraise there, 7,500 crore QIP, 109 rupees a piece. It comes in at a 5% discount to yesterday's close. Power Grid may not see too much in terms of stock activity, but the big development, it's been the successful bidder for the Khavda project. Reliance Power, this hit upper circuit in trade yesterday. They've successfully raised 1,525 crores via preferential issue, with one of their parent companies coming in with 600 crores. AstraZeneca, it's a big one. They've got a nod and approval to import a drug for cancer treatment.
All right, well, of course, moving on, we are also keeping an eye on Thangamayil Jewelers. Well, they will raise, or rather mull a fundraise on the 26th of September. GR Infra, well, the lowest bidder for a 904 crore project for the Nagpur Metro. And we also have Ipca Labs, where Nomura has hiked its price target on that one. In terms of some negative developments, where we have BGR Energy, which has ended its 440 odd crore order. And Sky Gold, this one has been on a tear. But we understand that, veteran investor Ashish Kacholia has sold less than 1% stake in the company. So we will be keeping an eye on this one as well.
Well, those are all the stocks you want to track as we gear you up for trade this morning. Remember, it's going to be a flat start with a slight positive bias in early minutes of trade. This comes in after the bulls have held complete control of T Street over the last few days. Rajat Bose and Sunny Agarwal join in with the technical and fundamental view. Rajat, I'll start with you first. It was a record close on the index yesterday. We closed shy of 26,000 on the Nifty. As we go on a trade today, what are you expecting? Consolidation, or could it be another day of a strong gain on the Nifty?
The probability has it that you might see another strong gain, because the way Nifty has acquired momentum after maybe say 4 or 5 sessions of sideways activity. Now the level that you need to watch out for is that if the Nifty now doesn't fall below 25,871, that's a critical level, then you can expect that upward momentum to continue. How much it can go? Initially, 60 points ahead, we have the 26,000 landmark. But what I'm looking at is the 2.618 times Fibonacci, that is 26,652. What is 2.618? This is the high of 3rd June and the low of 4th June. High of 3rd June was, I think, 23,340 kind of level, and 21,800 was the lower level. From that, if you draw a Fibonacci projection, 2.618 times is 26,650, 652 to be precise. So all I'm saying is this, that this 2.618, I have seen over a period of more than 3 decades, that this one, from if you draw the Fibonacci from significant high and significant low levels, that becomes a target, and also that becomes the level where profit taking will definitely happen. Of course, it's a matter of probability. We should not be saying definitely, but chances are. So I would say no problem with the Nifty so long as 25,870 is not broken. Now, if you talk about the bank Nifty, two targets are there, 54,300 and 54,650. If 300 might be crossed because banks have got all the momentum now, and if 54,650 is crossed, then you can expect 55,000 also would be scaled up. So we are going with the momentum as of now.
Rajat, on Bank Nifty, would you initiate a fresh long this morning if you get a flat start?
Well, as I said, that I would go long with the stop below, say, 25,850, because 25,870.
I meant, Rajat, not on the Nifty. I asked you about Bank Nifty.
Oh, Bank Nifty, yes. Bank Nifty, I would say that 53,800 should be your stop loss, and you would be expecting 54,300 and 54,650. These are the two levels as I told you.
Sunny, yes. Is there more steam left in this rally? We are lacking triggers, at least between now and earnings season that kicks off in October.
Yeah, good morning. What I feel is that ultimately one should not look at indices. In fact, stock-specific activity is something which is the trend of the day. Case in point, auto is in focus with many news flow over there. Mahindra & Mahindra, Skoda JV that is coming up, Hyundai IPO which is lined up. At the same time, two-wheeler sales volume continue to do well. On both IC as well as EV side. So I think a capital market theme, for example, continue to do well in a buoyant market. So I think one should look at stock specific or sector specific activity rather than getting glued to the indices level. In terms of indices, I feel heavyweights like especially rate sensitive like banks, NBFCs, real estate and auto, as discussed earlier, have started participating in the rally. Don't know where it will end as far as top is concerned. But ultimately, what I feel is that market is a buy on dip market if somebody has got a medium to long-term investment horizon.
Right. Well, Rajat, top trading ideas this morning. Everything looks good for a buy.
Well, since I told you that I would like to go long, of course, I don't trade myself personally, as I've told you. So Bank Nifty you can trade, but my trading ideas are in the stock segment. I would prefer a life insurance company and a jewelry company. Buy Titan, 38.20. It looks pretty good. 37.95 would be your stop loss. And the target should be 38.50 and 38.83. Buy HDFC Life. You could also do the same with SBI Life, but I prefer HDFC Life. Stop loss 717, target 738, 747, 753. These are short-term trades. By no means they are an intraday.
That's as far as Rajat's views are concerned. Rajat, I want you to come in on Zomato because that's the one that continues to move from strength to strength. It continues to make new life highs, and it seems like there's no stopping this one. The question really is that there may be a little bit of FOMO play here from the investor's point of view. Would you still initiate a buy in Zomato at this point in time?
Agam, I have one problem. I have transacted Zomato about 10 days back or so. So I can't offer you any view because we have 1 month. If I do any transaction, then 1 month I can't talk about that as per SEBI regulations for research analysts or registered intermediaries.
Fair enough, Rajat, but I'm sure that our viewers will read between the lines because since you're already invested in there. But in that case, Sunny, let me take this question up for you. If fundamentally, how is this stock looking? It's going to be very interesting after Swiggy comes in to play as well, even once it launches its own IPO little later on in the year, perhaps next year early.
Yeah, definitely. I think all the businesses are firing for Zomato, food delivery, as well as grocery business. And on the top of that, the kind of excitement we have seen on the recent concert ticket getting sold out, and then again reselling happening at exorbitant prices. I think the Zomato's acquisition of Paytm is likely to deliver a fantastic return in a very short period of time. The kind of experience which youth is trying to get. I feel the going out, eating out, enjoying, and all this ticketing business is something which will become a next leg of growth driver for Zomato, maybe 2 years down the line. We continue to remain bullish on Zomato, and we believe the long-term trend is bullish both on operational metric as well as financial metric. And I feel the fair value at the current juncture is close to 350 rupees with investment horizon of 6 to 12 months.
Right, Sunny, Rajat, stay with us. We'll take a quick break. We'll come back, track pre-open trade and... Welcome back. You're watching India Market Open. We're gearing up for another morning when it looks like it's going to be a positive start for D Street. Remember, cues coming in from the world are positive, and the bulls pretty much ended the day yesterday on a high. The Wix has seen a little bit of a jump up, but 26,000 is what the street is eyeing. Rajat, what are you doing with real estate stocks? They've been seeing quite a bit of activity over the last few days of trade. Anything in the real estate pack that still looks good to go long on?
Samina, you must have noted one thing, that is, there is kind of rotational activity going on. These two sectors, the banking sector, real estate sector, life insurance or insurance sector, they were not in favor until recently, and now they have come in for good move up. In that space, Godrej Properties I regularly track because I have advised long back to my clients. I feel that at 3162. If you are a short-term trader, then you can expect the earlier high around 3400 might be rescaled. In that case, you put a stop loss below 3100. It is from 3192 to about 3400. That is what I can project as of now, because that's a top earlier. If that top is crossed, then maybe 3550 would be the thing to go for.
That's the view on Godrej Properties. Sunny, coming in on the QSR space, we've started to see a little bit more traction returning to something like Devyani, International, or for that matter, a little bit of resurgence in Jubilant Foodworks, Westlife Development. What is your view here? Because we've also had a note on urban consumption of late. How are you assessing some of these names going in?
Yeah, definitely what has happened is that during the last 6 to 8 quarters, the demand has been very tepid as far as QSR sector is concerned. And now the street is hopeful that on the low base, SSSG growth is something which will come back in second half of fiscal year 25, led by festive season. Again, it's a hope trade. As of now, the commentary is cautiously optimistic from all the QSR companies. But having said that, again, this is a sector which is which will be a huge wealth creator over the long term. So what I believe is that if somebody is looking to accumulate a quality business for a medium to long term perspective, I think Jubilant Foodworks and other players like Devyani, RBA, Westlife. So entire pack can be accumulated through SIP route. But one need to have patience over here. September quarter again will be a kind of muted quarter. No firework expected in the September quarter. And it is the December quarter which will lead to which is expected to post a solid earning growth. So I think patience is something which is needed in QSR space. Obviously, under-owned sector, the sector has been underperforming since long. So there is a kind of under-ownership also sitting over there. So what I believe is that one need to have a really long-term vision to hold on to this stock and create a wealth in the entire QSR space.
That's, of course, a couple of those QSR stocks that have been seeing activity. But up next is 9 o'clock, and it's time for us to take a quick check of how pre-open is playing out. There was some indication or hope that we'd have hit 26,000 at the get-go, but remember, because we've had it so sweet over the last few days, it could be a morning of consolidation. And from what pre-open is indicating too, in fact, instead of a gap up, it looks like it could potentially be a subdued start to today's trade. And opening around 25,900 is what we're expecting. A quick check on the dollar rupee as well, because that market has opened up for trade. It's a flat start on the local currency. Remember, post the Fed rate cut, the anticipation was that the dollar would sell off quite sharply. 83.56 is comforting for now. Across the commodity universe, everything is looking good. So gold futures, silver futures, MCX gold, MCX silver have all opened up with a 1% gap up as we see it. Aluminium, copper also trading marginally higher. Natural gas is up 2.5%. So the whole commodity universe is seeing an uptick in trade on back of China's rate action. And of course, let's not forget that you had the Fed rate cut only a few days ago. But all in all, it's a good start for commodities and the currency market. The Nifty on its own trading flat. Talking about brokerages, as always, it's 9:04, and we will be going across to Harsh for a quick view on what Nomura has to say on Ipca Labs. Harsh, it's over to you.
Well, 20% upside actually, which Nomura now has on Ipca Labs. They've hiked the target price quite sharply from 1,500 to 1,750 rupees a share. Keep your eye out on this one. What Nomura is saying is consistent performance in the domestic formulations market, of course, is the one key positive for Ipca. But outside of that, improvement in generics, API, as well as cost and revenue synergies are expected to play out, especially with regard to subsidiary Unique Chem. You're also expecting to see a 30% CAGR from FY25 to 27 with strong momentum. Post FY27 as well is what Nomura is building in. Margins now better than what Nomura was earlier anticipating, 24% to 27%, and hence the hike in terms of target price. Margins expected to go up from roughly 23.6% that was expected in FY27 to 25 to 26%. So that increase should therefore aid both the target price as well as the overall numbers. Focus on biologics and CDMO. Now, the revival in CDMO is going to hold the key if at all that were to happen. There's some drag with regard to US FDA approvals coming through, and if that were to reverse, that could again be a key positive with regard to IPCA. In terms of what the management is penciling in, they're expected to grow at 1.4 times the pharma market. 12% growth expected in FY25. US revenue, including Unichem as well as Bayshore, may scale to around $200 million. Ex-generics growth will be driven largely by new markets as well, and capex plans have gone up. Consolidated margin expected to be around the 25 to 26%. So some key positives coming through, and of course a large hike in terms of target price.
Huge one. And IPCA Lab has been on the buy side now for quite some time. There have been a whole bunch of brokerages over the last quarter that have come in aggressively upgrading the stock. Sunny, do you cover IPCA Labs? I know it's shown up on a couple of recommendations from fund managers too recently. Nomura now aggressively upgrading this target price on IPCA. What do you feel? How do you feel about this one?
Sorry, we don't cover IPCA Lab.
Rajat, do you cover, can you tell me what the charts of IPCA Labs are looking like?
See, the charts are suggesting that even the short-term trend, very short-term trend, of course, there had been a 5-day or a 6 trading session correction, and after that, yesterday it has moved up. Otherwise, short-term, medium-term, long-term, all trends are up. Only thing is that it has moved up considerably, but the kind of momentum and the kind of chart pattern it is showing, that its immediate target would be something like 1550. And if 1550 is taken out decisively over a period of few days, it could stay at least a week, then you can expect that its next major target would become 1800. And that would be a couple of years target from now.
Well, that's IPCA Labs for you. That's the technical view coming in from Rajat. Sunny, insurance companies have been seeing some buying, and we talked about that. Rajat also highlighted a few of his picks, which highlighted insurance plays. Anything in the insurance pack that you like, and is there a reason why you expect them to move further higher from these levels in the private insurance sector?
Insurance has been in limelight basically for two reasons. One is the expectation of a rationalization of GST rate on health insurance front. So I think that is something which is keeping street excited. Lowering of a GST burden can definitely give leeway to push health insurance as a product. At the same time, life insurance, the month-on-month premium collection numbers has been pretty good, especially for few players like Max as well as HDFC Life. And on the top of that, there is an expectation that going forward, the life insurance players can also offer a health insurance product, general insurance product. So I think a lot of changes that are happening in insurance as a sector. And anyway, it's one of the under-penetrated category, and the long-term outlook continue to remain robust. At current juncture, I would like to place bet on a general insurance sector, and within that, I would like to bet my money on ICICI General Lombard, which is the leader in this category, followed by Star Health, where in case there is an rationalization in GST rate, Star Health can be another beneficiary in a short to medium term.
Okay, well, with that, let's get in Puneet, who is going to talk to us about M&M, who issues a clarification on Skoda Auto stake sale. Puneet, good morning. What do you have for us?
Well, thanks for that. So, yes, they have issued a clarification yesterday on the Skoda Auto stake sale. They have mentioned that currently they are in talks with multiple opportunities with Volkswagen, and they haven't mentioned specifically on Skoda Auto, but they have said that the company has appropriate disclosures made in a timely manner as per the SEBI regulations. They've also said that Mahindra as well as the Volkswagen Group continue to explore multiple opportunities to expand collaboration further. Now, just the current, they have a supply agreement with the Volkswagen Group, where Mahindra will equip certain range of electric vehicle components from Volkswagen into the Ingloove platform. Now, specifically, Volkswagen will supply components that are also used by its other group brands such as Audi, Skoda, as well as Seat, as well as the Cupra brand. And specifically in India, it also supplies that to Ford as well as to Mahindra specifically. Now, a definite step. This was a definite step which was signed back in 2022 to increase the joint venture for e-mobility expansion in India, and specifically the deal covers supply of electric vehicle components as mentioned for both these players. Now, Mahindra is expected to launch 5 new electric vehicles starting from December 2024 on the Ingloove platform, and components will be used specifically from the Volkswagen Group. Skoda. What's also interesting is that Skoda India has announced a new plant in Maharashtra, in Chakan and Pune, and they'll be investing roughly 15,000 odd crores. Now, this was announced by a tweet by Devendra Fadnavis, the current deputy CM of Maharashtra. And what's interesting is Mahindra also has a plant very close to there in Chakan itself. So there is a lot of speculation on media reports for a further collaboration increasing for Mahindra as well as Volkswagen Group. But we will currently await more details on the same. Back to you.
This one was one of your top gainers in trade yesterday, Puneet, and while this cannot be viewed as a negative, it's also not, it's too early to call it a positive just yet, because we are still awaiting deal clarifications between M&M on Skoda Auto. Well, the stock is expected to see a 1% gap. And a quick check on how some of those big counters are looking like. HDFC Bank, ICICI Bank, Reliance Industries, ITC, was some of the movers. SBI, some of the counters that were active in trade yesterday. This morning as well, not expecting too much. But it's going to be metals and the China action of cutting rates on existing low lending is what's going to be the big movement. They have cut down the minimum down payment ratio for second homes as well to 15%. So the metal universe may see a sharp uptick in today's day of trade. So if the markets have to move, even though it will be a sideways day of trade, trading opportunities will show up in the metals pack. Rajat, in the metal sector, if there's anything you want to pick up, what would it be this morning?
See, in the metal sector, I suppose since the Tata Steel has actually moved beyond the 9-day moving average, it needs to take out the levels of say 156. Once it does that, then you can expect some kind of a movement happening there. And the next level would be 162, and after that, it would be 165. So Tata Steel is getting traction because that they remain between say 155 about 150, and after that now breaking out above that, chances are that you will see some movement there.
All right. Well, that's Tata Steel for you. And, let's take stock of a handful of names which are now starting to prop up as well. And, one of them is Bosch. Let's pull up the chart of what Bosch is doing. It does seem like it may potentially start to see, it may have another positive day of trade. For now, it's unchanged, but it was up, and it's starting to gain a little bit more positive trend. Over the past 1 month, it has advanced by as much as 12%. Rajat, anything that you observe in Bosch, any opportunity here?
Well, definitely there is an opportunity here because Bosch is now, it has closed above its earlier high. Yesterday it did that, and the earlier high, earlier closing high was much less from the current levels, and immediate expectation would be something like 36,500 once taken out, then 37,200 would be the next target to watch out for. Bosch is clearly bullish because it has completed its short-term correction, and after that, 3 strong moves over the last 3 trading sessions that has changed the thing, and the volume has also been pretty good. I wouldn't say very good, but pretty good.
All right. Sunny, let me come to you on a very quick take on names like Kalyan Jewellers and Senco Gold, because you're starting to see positive traction there as well. How are you addressing these stocks at the moment?
Yeah, definitely. I think the sentiment has been further boosted by the listing of PN Gadgil, where we have seen a robust listing gain over there. I think compared to PN Gadgil now, Senco is trading at a cheaper valuation. So I believe it's a valuation re-rating game which is going on in the entire jewelry sector, obviously backed by the robust demand. There is no doubt in that post the custom duty cut during the last budget. At the same time, the commentary continued to remain bullish on the demand environment from all the jewelry players. And if I have to bet my money at a current juncture, I feel Senco Gold is trading at a relatively cheaper valuation compared to other peers. And at the same time, B2B player like Sky Gold, although we have seen selling by one marquee investor yesterday, but I feel the potential of growth is still significantly pretty robust for Sky Gold. And from B2B space, I would like to pick Sky Gold in my portfolio.
Oh, there are so many stocks to watch out for. Gold, member, is a sweet spot. Commodities will be in focus today. Stocks like Tata Steel, GSW Steel, Nalco, Vedanta are counters to watch for on back of last week's Fed rate action and this morning China's rate cut action. Those are factors that will support commodities as a whole piece in today's day of trade. The market is trading flat. I don't think anyone's complaining after the very sharp rally we've seen over the last 2 days. We are back to 25,900, just sub that on the index, 38 points lower is what we have. Some profit taking is what is the order of the day so far at least. Bank Nifty is down 0.2%. They've also been in a sweet place for the last couple of days now, taking a little bit of a breather as we see it on Bank Nifty and on the index itself. In terms of the broader market universe, yesterday saw the broader markets bouncing back quite well, and there's outperformance once again. The mid-cap index trades marginally higher, the small-cap index also trading with a small gain as we see it. Across the sectoral picture, I would have imagined commodities to start doing quite well, and in fact, if we can quickly pull up commodities, it is metals all the way, 2% higher, 1.5% higher is what we have. The wicks are also seeing a little bit of a jump again. On the sell side, you've got Nifty IT that continues to look weak, but the rest of the space not looking too bad as we see it. Well, in terms of the Nifty 50, stock of the morning has got to be Hindalco, 2% higher, JSW Steel, Tata Steel. So everything on back of China's rate action is helping metals this morning. Defense also looking good. So you've got counters such as Nestle, Asian Paints, ITC that are trading with a clear positive bias. On the sell side, you've got HUL, Infosys, Cipla, Wipro that continue to see weakness in trade. But I think, Agam, the day belongs to metals. It's subdued, no runaway gains, but doesn't come as a surprise because we've had it so good for so long now.
Yeah, and Samina, in terms of the broader markets, they look interesting at the moment. So firstly, if you consider there's marginal outperformance for something like the mid-cap index, which is up as much as about 0.25%, the small-cap index also to a certain extent advancing, or rather it's unchanged at the moment, but there was a positive tick right at the start of the trade. So that a little bit of an outperformance when it comes to the broader markets continues with respect to the benchmarks. The benchmarks are currently flat, marginally in the red. But let's take a look at some of those stocks which are in fact in focus on account of several news flow and several other updates. We start off with a handful of counters which were in the news on account of fundraising. PNB, of course, looking at a 7,500 crore QIP, but it's currently in the red marginally. Reliance Power, on the back of that 1,525 odd crores funds raised already, it's locked in an upper circuit of 5%. And Thangamile Jewelry also up by around 2.7%, even as it considers fundraise on the 26th of September. Moving on, there are other counters which are also in the news. We have AstraZeneca, which is up as much as 5% on account of an approval for a drug. GR Infra up around 5.3% as well, even as it wins another order, or rather it is the lowest bidder for an order worth around 904 crores. And BGR Energy is currently unchanged. We also have a handful of broking notes this morning, and on account of that, Ipca Labs is up around 2.3%. Positive traction there. MK looks at a 20% upside for GMR Power as well, and 13% upside for Paytm. And on account of that, we are looking at gains for Ipca Labs, GMR Power, as well as Paytm. So all in all, the broader markets certainly looking slightly better off than the benchmark indices, and it's going to be a wait and watch But perhaps the biggest weight of all today will be whether or not the Nifty does move over 26,000. Do remember there is a little bit of resistance there, and that's going to be something that a lot of traders will watch out for, Samina.
It's a healthy profit taking or flattening out as we see the index after a sharp move over the last couple of days. Agam has already highlighted a few counters that he's tracking on back of news this morning. But a few more to that add to that list is AstraZeneca has got to be the stock of the morning. A nod on the cancer drug to import that is helping the stock do quite well. It's trading with a gain of 5.5%. Vijay Kedia picked up 0.5% stake in VIP Industries. The counter looks good, up about 0.5% as we see it. Nalco is up 4.5%. Auto continues to look okay in trade. You've also got stocks like Keynes Technology that are trading with the positive bias, but the day belongs to metals. So anything across the board in metals, no runaway rally, but 1.5% to 2% are the sort of gains some of those metal counters are witnessing in trade. On the sell side, Devyani International is down 2%. You've got some of your PSU banks that are seeing profit taking. Tech continues to look weak. It's a matter of time that you will see some bottom fishing or lower level buying that emerges on the metals pack. Today is just not the day for that. You've also got stocks such as Titagar Rail Systems, Easter Planners, real estate has taken a bit of a break. Insurance counters that were doing well yesterday also in a bit of a backseat this morning. Rajat, stocks that I want to come to you on, with the way things have opened up, the frontline metal stocks like a Tata Steel are up about 1%. Would you initiate a fresh long? And if yes, which metal stock would you look to buy for the day?
Yeah, I've already talked about Tata Steel, but apart from that, I think JSW Steel looks pretty good. Hindalco looks good. Hindalco currently at 701. It can, once it crosses 705, then next target would be 711 and 720. So Hindalco you can look at, and also one stock that I would suggest you can still go on buying is MCX. MCX strongly trending. Even in today's session, it is moving up. You can expect say 5,950 to about 5,975 going forward. This also looks pretty good. Devyani and other things that you have mentioned, Ipca Lab, of course, stands out. Ipca Lab has broken and it's moved up with a gap, and after that, currently at 1507, 1520, 1525, and thereafter 1543. These are the targets for Ipca Lab. Devyani, I would say you avoid for the time being. But you mentioned AstraZeneca. That looks pretty good. AstraZeneca can still move up, and this time it is showing traction 726, 7245 or 7250. That is the kind of level it is trading now. Put a stop below 7180. It can move up to something like 7350. So AstraZeneca is also pretty good because the somewhat a symmetrical triangle is being broken out, but it is a weak breakout. Still, AstraZeneca might do well.
Right, just very quickly, Rajat, I want to pick up on some of those consumption names. If today is going to be a subdued morning, I would imagine stocks like a Godrej Consumers and ITC and HUL, even though have started the day off flat, should start seeing some buying over the next few hours, so could make good intraday opportunities, you think?
Well, I suppose ITC, if it were to cross 520, then you will see some momentum coming back in ITC. But otherwise, you can look at stocks like Nestle, which is going an uptrend, strong uptrend. It's, I think, the fourth or fifth day, but still it is crossing up a critical level of about 2740, 2750. If it manages to stay above 2740, then you can see it going up. Godrej Consumer also looks pretty good in my view. Godrej Consumer currently it needs to take out. It needs to take out. Godrej Consumer needs to take out 1458. But if you have to bet on momentum in these kind of stocks, bet on that has got the best.
Okay, Sunny, come in on the real estate pack as well. We've started to see a lot of strength return to names like DLF, Soba, Oberoi Realty, even some of your relatively smaller names like Signature. How are you looking at and addressing this particular sector going forward?
Yeah, on real estate front, definitely pre-sales number has been pretty robust. But only thing which worries me at a current juncture is the latest decline in registration number since last 2 months. So there has been a YOY decline in registration number during the month of August and a month prior to that. Again, I would like to play this story through urban stories like Macrotech, which is the owner of Lodha as a brand. Looks relatively trading at a relatively cheaper valuation. In addition to that, Century Textile, which is an basically real estate arm of Aditya Birla Group. So these are the two companies which we like among the real estate play from a medium to long term investment horizon.
Well, Sunny, Rajat, great having both of you on the show. Thank you for talking to us. That's the word coming in the metals. The day belongs to metal stocks, but there is a little bit of a recovery coming in to counter, such as an ITC and a Godrej Consumers as well. While we are talking about sectors and smaller sectors rather that have been in the news for various reasons, we have Mayur Malak, Senior VP Research Auto and Aviation of Asian Market Securities, joining in to talk to us about everything that's happening with SpiceJet. Mayur, good morning. Thank you for taking out the time to talk to us. Just a few days ago, we had a very successful completion of the SpiceJet QIP. Some parts of the market believed marquee investors like Madhu Kela had made an allocation too. Turns out that's not completely true. What did you make of this QIP, and do you think enough has been done now for SpiceJet to start charting its road to recovery?
Yeah, so, first of all, congratulations to Ajay Singh and team. I think pulling off a 3,000 crore QIP is not a small task, especially in this scenario where they stand today with a lot of allegations and a lot of commitments for payments. But having said that, I think the Indian skies are in a beautiful space. I think, there is hardly any competition, any serious competition now, limited players. The fares are holding up pretty well. The pricing war story is behind us. Crude has come in favor. So I think a great time for somebody to look at Indian skies. And then obviously you get only two listed names to play at. So yeah, clearly I think that was one prime reason why SpiceJet could have pulled it off so beautifully.
So you're convinced, Mayur, that despite the medium-term concerns that SpiceJet is currently facing, once the recapitalization is completely done, and the funds have been utilized to prepay the debt, do you feel like the upside is significant? And if yes, would you recommend, or do you have a buy call on SpiceJet then?
So we officially do not have a coverage on SpiceJet yet. Okay. Too early really to say that, this is a super positive. I'd say this money will definitely help them to get out of the woods, get into action. I think it helps them to take care of their grounded aircrafts. You are entering a peak season for the aviation skies, right? The October to December, and then again Jan to March is a great period. So I think getting those planes back into action will definitely add a significant profit to your overall profit growth. That I think will definitely help them. But clearly, the mathematics of the game suggests that they will need another round of funding to, to fuel up a stronger growth. So, but I think with this money, they can at least show the intention of growth. And then once they are on the growth path, they will definitely need one round more of money is what we anticipate.
Right. You want to tell us about Interglobe Aviation, because you did say that it's clear blue skies and the sector has got to go only one way, which is up. If you don't have official coverage in SpiceJet and it's not a preferred bet, do you like Interglobe Aviation?
Yeah, I think Indigo is a clear-cut top buy. We've had it as a top pick for the last entire year now. I think we've been telling to clients very regularly that, the biggest thing that was holding back the profitability in these skies, other than, of course, the crude factor, was largely the pricing war. I think with Tata's coming in, with this game sorting out, the pricing war is definitely a thing of history. You are in a scenario where, where demand is very steady. People are ready to pay a bucket price of 4,000 and above in a very regular, consistent way. We've gone back to good numbers. The crude factor has come off critically, right? So we, at the beginning of this year, we were building crude at $85 to a barrel. It is practically down between 70 and 75. Now, crude oil being 40% of your cost, that gives you a big heads up. For any other cost that could typically come up in either way, plus adds a lot of cash flow and profitability to your numbers. So clearly, I think we have a strong buy on aviation and interglobe aviation. Yeah, I think our initial target price was 5,500, but I will stick my neck out in saying that there's clearly an upside to that target price as well.
Exciting. I'm sure viewers love to hear, convincing calls such as this one. Do you feel like there could be a direct impact on margins with the introduction of business class now by Interglobe Aviation? Some of it may not be immediate, but in the medium term, do you think margins stand to see a significant upside on Interglobe?
So I think, yeah, see, we've over the last decade, we've known Interglobe as the best low-cost model entry-level play, right? Clearly, they are trying to walk a new strategy for something that they've not really been known for. So yes, there is going to be a task for them as well. They've never proven metal into offering a better service than a low-cost model. I think that is the best model that they've showcased in the last so many years. But clearly, I think this possibly comes at the back of the fact that they now have a 60% plus market share in India. So the obvious choice for them for the next leg of growth will be to go international. And then what better to start with, a change little in the domestic services as well. So I think this clearly defines a new path. But yes, we will have our entire lens on how they prove this one as well. So clearly, yes, a new thing to watch out for, but I think they are on the good path.
Any downside risk to this, Mayur? Because while I understand that they've got ambitious plans, but the fact remains, and we've seen this from numbers last month with the maximum number of flights cancelled for Indigo. That also could be because of they do have the maximum number of flights in that sense, right? So it's all relative. But do you feel like this, with this whole venturing into the global marketplace, competing internationally, capabilities may take some time to catch up. Any sort of risk you see for Interglobe achieving the target it has and you have as a consultant on the stock?
So I think see two things here. One, that clearly post-Jet, we've always had two players, right? Air India and Jet Airways, but post-Jet, there has been no second guy really to take advantage of the growth which lies for all of us outside of India. So I think Indigo definitely would have seen a vacuum there. And I'm sure, they are a very capable team. They would have done their homework and their math of how they really want to do this. So while, of course, you have to up your game because now you're entering a global play, right? You have competition. Maybe you do not have as severe a competition in India, but globally, they will have the best of challenges to face out for. So yes, this is going to be an uphill task. But I think, with the kind of balance sheet strength they have, the kind of experience that they've had with all these years, a steady team, they would possibly be the best guys really to watch out, in this space as well.
What is the outlook on ATF prices? Given the way crude is moving, it's becoming very tough to predict the outlook, right? Because on one hand, your demand is under pressure, but on the other hand, you have worries such as geopolitical stress that keeps crude higher. What is the impact of that on ATF, and what do you see in terms of trajectory?
See, I think two things here really nobody can really predict where crude is going to go. But a very interesting thing that I would want to believe, you have two oil nations, right? Russia and Iran, both directly or indirectly involved into some kind of war space. So clearly this crude would have some kind of premium based on those two wars. Clearly crude coming off from 85 into the $70 space tells you that the global demand is questionable. So while there is a supply glitch, this was always there for the last 2 years, but clearly demand is not as high that could have possibly had its impact on the price. So I will want to believe that, that unless you do not see a very, very strong global demand coming in, there is definitely a further upside to crude prices being further down. If any of these wars were to kind of neutralize. So clearly, I think the $100 regime is not really visible in the near term. Of course, I'm still not an expert into commodities, so can't really take a call on that. But at least the global logic suggests that we will remain in the best case scenario should be like a $70 to $80 for crude, which I think is great for Indian skies as far as the aviation guys are concerned.
Very lastly, Mayur, what's the price target on Indigo? And if I know you don't track SpiceJet or cover it in that sense, but if you have a price target, that'd be great.
So I think Indigo, we have a buy with a target price of 5,500. But as I said, the number demonstrated by them into their quarterly profitability clearly has an upside from beyond of what we are targeting as of now. That is where we are. And SpiceJet, I think, yes, looks good, but we do not have an official target price on that.
Well, thank you, Mayur, for that. That's the word coming in. Interglobe Aviation is a clear preferred pick by Mayur Malik, who's been tracking this sector for eons and is an expert in the space. Well, moving on from there to one of the stock that's been buzzing, and that's been Hutco. The PM Awas Yojana is set to contribute around 75,000 to 1 lakh crores to the company's AUM. Samina caught up with the chairman and MD Sanjay Kulshrestha on what's ahead. Listen in.
Government of India has came out with PMAY 2.0, and we are experienced lender consultant under PMAY 1.0 also. And HUDCO has been given this responsibility to see that all these visions of the country, Government of India, should be replicated at the ground. So under PMAY 1.0 also, HUDCO has extended loans of around 43,000 crores. And the way the expansion of this PMAY for rural and the urban, it is around 3 crores households which will be built across the state. So need and necessity has already been devised. So I am very sure that this program of the Government of India will become a game changer in terms of the Viksit Bharat vision, and a lot of infrastructure around these households will also be created. So whatever infrastructure which will be created across these households, that will also be funded by HUD. So the potential is very high, the commitment is very high, and we will be responsible for that.
What is the current AUM for the PM Awas Yojana, Mr. Kulshrestha?
Under PMAY 1, our AUM is 43,000 crores.
So you're saying it will go from 43,000 to 1 lakh crores, possibly, in what time frame?
Within a year of 3 to 4 years of the time. And some of them, most of them will be the upfront. So within 1 or 2 years of the time, around 60% disbursement will go, and balance will be in the third and fourth year.
No, so sorry, just to ask that again. By the end of 3 years, what is this AUM that you see under PM Awas Yojana? Is the 1 lakh crore figure for the end of 3 years, 1 year or 2 years?
It will be for 3 years.
Okay. So considering that there has already been robust growth, do you think it will take another 2 years to add maybe 60,000 crore rupees to the AUM?
Yes, you can say so. Another 2 years will be quite a good time that will be required for addition of this.
The other thing that you're hoping to do is bring your loan book to 3 lakh crores by FY30. That's in another 6 years. Where is that growth coming on in your view? What is going to be the driver? Is it going to be government schemes like PM Awas Yojana, or are you looking at other levers?
Actually, HUDCO is the company which is responsible for creation of sustainable and viable infrastructure across the country in line with the vision of Honorable Prime Minister. We had seen during last week also, CRISIL has came out with a report that around 142 lakh crores of the investment will be required by 2030. So we are not limiting only to the PMAY. We are into the infrastructure starting from road, port, airport, water, sanitations, new towns planning, satellite towns. So HUDCO is there for creation of all the infrastructure and the subcategories of the infrastructure. So I don't think any restrictions will be there for this growth. And by 2030, 3 lakh crores will be quite a conservatively achievable task. And now our loan book is only 1 lakh crores. And we are targeting for this year, it will be 1.2 lakh crores. And by next fiscal, that is FY26, we are targeting 1.5 lakh crores.
Okay.
So reaching 3 lakh by 2030, I think we may have to revise our target mid-course.
Revise it upwards, you mean?
Sure. Upward, naturally.
Okay, so tell us what is the contribution of PM Awas Yojana to the loan book currently?
Currently, it is 43,000 crores.
Okay.
Currently, loan book is 43,000.
Okay. Now, tell us you gave us the broad indicators of all of the infra works that HUDCO is on, and you're saying that 3 lakh crores by FY30 is actually a conservative amount. Where do you see the big boost coming from? I'm just trying to understand if Awas Yojana has sort of been tapped, that is very clear. What else are you sort of working on, or where the bet is?
Government of India under the general budget has identified 9 key infrastructure segments, and HUDCO is present in all the 9. So it may start with the mobility. It includes road, port, airport, surface transport, connecting roads, regional roads, ring roads. So everywhere, wherever the infrastructure is, the name is coming, HUDCO will be there. Second capital intensive category I can say is the energy transition. So we are into the energy transition, creation of the solar parks, land acquisitions, solar plants, and then pump storage plant. And we are even financing the conventional power plants. Then third, I think is a new towns which will be planned, new satellite towns which will be planned, along with the urban infrastructure like water or like metros or other source of the urban mobility. So all these 3 areas we will be targeting in next 3 to 5 years of the time.
And as far as PMAY is concerned, what are the kind of margins that you've penciled in for PMAY? Can you also give us a broader idea of how you see margins panning out for this financial year?
During last PMAY also we were the major lenders, and our margins will remain at around 1.8%, and we will be maintaining that.
Okay. And for the entire book for HUDCO as a whole, apart from PMAY, what is the trajectory for the margins?
At least 2%. We are maintaining at around 2.2, 2.1. So the minimum benchmark which we will be able to maintain between 2 to 2.25.
What is the quality of asset in a scheme like PMAY? Because you talked about not just the structure, but the surrounding infrastructure which you're building, etc. What is the asset quality that you're seeing and the recoveries? Because I believe that there is some pending recoveries as well, up to 1,500 crores.
Actually, what figure you are mentioning, it was way back in 2013. We had sanctioned some power plant in consortium. They had gone bad, and now they are into the different stages of NCLT. And during this quarter or next quarter, we will be resolving 2 of them, like KSK, Mahanadi will be resolved, and now Coastal Energy is also resolved. We are getting 90% to 100% of the recovery, and provisions are to the extent of 100%. So it is the talk of the past, and that we had already came out of that thing. So from last 3 years, like 12 quarters, we doesn't have any new NPA. So the asset quality, as you have asked, in the PMAY, it will be excellent. That will be backed by the state government, sovereign entities, and the repayment will be done by the budgetary allocations only. So we are very sure that there will not be any iota of bad going. So these are all social sector schemes, and the state takes the responsibility.
Is there any lag in the repayment schedule?
No, we have not seen. From last 3 years, there is no lag. We are getting our payment on time, and they are properly accounted in the budgets.
Okay. Just to come to the key question of cost of borrowing, and now that we are heading towards a downtrend in interest rate cycles, what does that mean for you? If you can give us some insight on that.
Yeah, this is a good news from the Fed that we all had heard, 50 basis rate cut, and we had taken hours of discussion then that when the rate cuts will come. So now it has really happened. And now we are started talking about another rate cut of 50 basis point, which we are hopeful that by this year end it will come. At the same time, we are expecting that some good news will also come from the RBI. But nevertheless, our efforts to reduce the cost of fund as far as HUDCO is concerned, we are taking all out measures, be it internal measures or be it external measures. In internal measures, we had started working on how to manage our ALMs, how to manage our provisioning, how to manage our HQLA, and all these things, that how internal cut down of the cost will happen. And second is external cutting down of the cost of funds. So we had extended our borrowing to yen denominated market. We had borrowed around 600 million. We had taken FCNR support also. We had borrowed around 5,600 crores. So now our external commercial borrowing book is more than $1 billion. So it will go on for this year also. And we have been successfully cut down our cost to 6.99 during last quarter. Today only we had raised the domestic bond of 2,000 crores at around 7.15%, which is in this set of market, it is a remarkable bond issue that we had came forward.
And now let's cut across to my colleague Neeraj Shah, who is in conversation with James Sullivan. He's the head of Asia Pacific Equity Research at JP Morgan from the JP Morgan India Investor Summit. Listen in.
An equity market only sits at about 5%. That's low by emerging market standards and offers significant upside as more Indians invest in the domestic stock exchange. And from a foreign investor perspective, JP Morgan estimates that about $100 billion has to come into this market just for offshore investors to get to neutral. Now, every month that the market performs, that's more and more index drag on offshore portfolios. To put that number into context, again, $100 billion US in incremental inflow. Year to date, we've only seen about $10 billion. So 10 times the year-to-date fund flow just to get to neutral. Now, we need to be careful what sectors and stocks we put that into, given divergence of economic growth, but we still see very strong prospects for outperformance moving forward.
So, let me start with the last point first, which is flows. For the last so many quarters, maybe global investors are putting money through the primary market route, but secondary markets have largely been devoid of incremental flows.
Correct.
Do you reckon this positioning to neutral, and therefore whether it's 90 or 70 or $60 billion odd, can come in with markets sitting at the levels and the valuations that the Indian markets are?
No, great question. In two ways to look at it. From a fund manager perspective, your index drag is getting worse and worse as the Indian market continues to outperform. And as the market performs, India as a percent of regional indices continues to expand as well. So again, that's it's a flywheel that's going the wrong way for a lot of offshore investors. And eventually you have to take the view, either the market has to go down significantly or you have to start to neutralize those underweights. We expect the latter, not the former, for a variety of different reasons. From a asset allocation perspective, again, shocking for a guy that runs a team of bottom-up company analysts, we think it's all about stock and sector selection. In particular, given the market outperformance that we've seen, incremental investments have to be targeted at specific sectors. One theme that we've seen from regional investors for really the last couple of years has been listening to government policy. That's been relatively effective in a market like China. It's been relatively effective in a market like India. So incremental government capex in infrastructure, particularly as it seeks to encourage offshore investors, that FDI that has yet to occur, to start to come into India, that's a sector that we're relatively positive on. I can't find an area of Mumbai that's not under construction right now. So clearly there's incremental demand there. If you look at electronic manufacturing, if you look at the defense industry as India seeks to reorganize its suppliers in that space, we see very, very strong idiosyncratic bottoms-up stories that can continue to drive selective outperformance.
There is physical, speaking of infrastructure, there is physical infrastructure, energy infrastructure, digital infrastructure, all getting built in a very big way in India, primarily through government capex maybe, but private starting to come in. Which part of infrastructure are you more constructive on?
So just on the investment perspective, I think it's critical to identify three incremental drivers. Number one is government. Number two is Indian corporates themselves. Number three would be FDI coming in from offshore. What we've actually seen is not just the first pillar. Government expenditure has been strong, and market reaction to that has actually been quite positive relative to other markets around the region. Right. Investors are very clearly voting with their pocketbooks that they believe that the efficacy of India government capex is reasonably strong, and that's not the case in some regional markets. And so that's an important differentiator here in India. Indian corporate capex has actually been pretty good. And so it's really been the third leg of the stool that has yet to come through in a big way, which incrementally we expect to start to see off the back of infrastructure spend from the government.
Okay, you do start to see, because one of the other pushbacks that some people have said that for private capex to come in, keep an eye on China, because if China were to face tariffs, if there is a Trump presidency, let's say, right, then China dumps goods across the Asian region in a meaningful way, and all those sectors might see pushback of capex plans because there will be a final goods deflation scenario that we see. How do you think about this?
It's a really good question. I think there's at least two angles to the answer. Angle number one is, if I look at most global multinationals, is there a geopolitical angle to the China conversation? Of course there is. Is there a broader risk conversation in that many multinationals understood that they became too indexed to one particular country and one particular supply chain? And are they looking to diversify that just for risk mitigation? Nothing to do with geopolitics. That's a separate and important, but separate conversation, right? So just from a risk mitigation perspective, you're seeing supply chain diversification because people had gone too all in on one link. And that's not good business. And so you're starting to see that diversification occur regardless of what happens with geopolitics.
Post-COVID, yeah.
Correct.
Right.
The comment that you made regarding the potential for China to start to aggressively export to different countries around the region, I think, is a fascinating one. Because effectively what we're saying is China's ability to export to the West in particular industries, let's say electronic vehicles as an example, is starting to change. And so one of the fundamental geopolitical conversations that we're trying to have internally at JP Morgan, what does that mean? Potentially quite a lot, because you potentially create different trading blocks. You potentially have differential macroeconomic variables at play within those differential trading blocks. Excuse me. And from a big picture perspective, China has been exporting deflation around the world for many years, right, as the exporter of choice. If that deflation is no longer being exported to the West, that's higher inflation in the West and more deflation in the rest of the world. And so that's something we're trying to understand. It's a very, very large structural change to the way the global economy will work.
Wow. And what are the investing implications of something like this, James?
We have to think very carefully about the implication for rates. We have to think very carefully for the implication for currencies. The beauty of the India story right now, particularly from a rate and currency perspective, again, go back to the top of the most important theme. This has been a DIY conversation here in India. The RBI currently has $700 billion in FX reserves. It has a more independent path forward in rates than most other Asian economies, which is interesting.
Yeah, it does. I mean, some levers that the Indian bank has vis-a-vis maybe some of the other countries, which is, I think, some of your colleagues yesterday were telling us that the Reserve Bank can choose when it wants to cut rates, doesn't have to necessarily follow the Fed, if you will.
Sounds like a great comment, which probably means it was Sajid Chinoy, who's our chief Indian economist, who's extremely good. And look, I agree with where he's coming from. And again, it all comes back to this DIY concept that India is in control of its own destiny in a way that not many economies in Asia are.
Yeah, that's true. Okay, the other aspect that you mentioned, manufacturing. And I mean, the defense and electronics are the poster boys. Maybe the stocks have run up too much. Some of them have corrected. Is there something else out there? Because there is a lot of other manufacturing attempts being made in a meaningful way. Is there something else that you like, bottom up, if you will?
So we're watching very closely the overall infrastructure sector, construction, electronics manufacturing, as you say. And that's really interesting because you've seen some very strong headlines in that space. So Apple's starting to relocate some of its assembly here to India. But again, the FDI numbers have not seen that flow through in any meaningful way. And so incrementally, we're watching that very closely and talking with a lot of the companies that we cover outside of India to understand their incremental capex plans.
Got it. Okay. What is it that worries you about India? It seems a promising story. Your colleagues were telling us 33% higher participation. Out here, if you are here, you can feel the excitement around India's story. Where is the worry?
So I'd say there's two elements to the answer, at least. There's always multiples, but two elements in this case. Number one, policy continuance. And so one of the stories here in India for the past couple of years now has been a relatively strong central government pushing a very clear and direct public policy stance. And if you look at Aadhaar, if you look at direct payments to Indian citizens, those have driven very different outcomes, and the market has recognized that. And again, one thing that we spend a lot of time thinking about is what is the market saying about different elements of government policy? I referenced this earlier in the conversation. What the markets are saying is that investors are very comfortable with deficit spending here in India. They're comfortable that there is efficacy to that spending. That is not the case in other regional markets, which is interesting. If you start to get any major shifts in government policy, if you start to see the policy platform changing in a meaningful way, or just a reduction in the power of the center, that results in forecasting risk, and that has to get priced in.
Okay, what's the other? So one is policy. Is there something else that worries you?
I think the other element that will be very interesting to watch, particularly off the back of the most recent election, national election here in India, is the degree to which you see the central government push more income redistributive policies. Sajid talks a lot, Sajid Chinney, our chief Indian economist, talks a lot about this concept of a K-shaped recovery. Other folks have mentioned it as well. The top bar of the K has done extremely well. And so folks like yourself that are very wealthy and well off have done very, very well. The bottom half of the K, less so. And so what we're starting to see off the back of the recent election is more and more policy attention to the bottom half of the K. That's very positive from a broader macroeconomic growth perspective and very positive particularly for the consumption space, which incrementally we're watching very closely.
So you're not quite constructive there yet. You're watching it, and you might turn constructive if indeed it finds more feet, is what you're saying?
We'd like to see more flow through into consumption spend. The beauty of that conversation is the incremental propensity to spend for lower income households is significantly higher than higher income households. And so if you do see income redistributive policies start to push funds into the lower part of the K, mathematically you should very clearly expect more spend, which would be positive for the consumption space overall.
Great. Last question. Within the Asia Pacific region, where is it that what's the pecking order? Where is it that you're more constructive on? I'm not asking for 1, 2, 3, but maybe let's say the top 3 and the bottom 3, if you will.
So we're starting to see investors start to get more serious about looking into putting capital to risk in China, which is interesting. Many investors have been doing a lot of work. We had our China summit in Shanghai in June. Very, very strong investor participation. A lot of people doing the work, but not yet pulling the trigger in terms of making those investments. We're starting to see that at a sector level in China, and that's something that we're watching very closely. Across the ASEAN space, we had our investor summit in Indonesia recently in Jakarta. Very, very interesting stories coming out of that market. Critical, however, will be to see how the incoming administration starts to structure public policy, in particular on the fiscal side.
Okay, and lastly, this China stimulus news that has come up, is it too little or is it meaningful enough for you to take note?
What most investors have done in China really for the past 2 years is increasingly wait for the data, not just put all their faith in the announcement. And so watching the flow through of those announcements into underlying macroeconomic data, into property sales, into consumption expenditure will be absolutely critical.
Great. Okay. James, such a pleasure talking to you. It's been a while, but thank you so much for speaking to us.
Thank you for having me.
The pleasure was ours, and viewers, thanks for tuning in.
watching Talking Point, but before we go across to Ajay Tyagi, we should quickly take a check of what's happening in the primary market. Action-packed, we've got three listings: Northern Arc, Arcade Developers and Western Carrier. So three big listings that are lined up and that should be hitting D Street in just a minute. What is surprising is the way the markets have turned around. We started the day off negative. The Nifty and the Sensex are now both trading at the day's high point. Sectorally, all sectors are trading higher. Broader markets are also performing in line with the benchmark. The sector of the day, though, is metals. The sector is trading with a gain of 2.5%. Apart from that, banks are also not doing too badly. And oil and gas is also seeing some buying that's emerged in trade. Follow-on buying is what I'd like to call it after yesterday's up move. Some of these counters have seen. Pharma looks good. The sectors on the downside is real estate. PSU Bank seeing some profit taking after a 3% up move yesterday. And you've also got private banks that are trading muted as we see it. Well, and it's the day for three companies that are on your screen, and as expected, the listings aren't looking too bad. The Arcade Developers was supposed to list at the 60% premium. It's not done as well, but a 45% uptick is what we have on Arcade Developers. Northern Arc also not as good as what the grey market premium was indicating too, but a 26% uptick is what we've got on the very get-go of trade as these three stocks debut on the exchanges. Arcade Developers, remember, is a Mumbai-based developer in the country, and it was oversubscribed about 107 times. Northern Arc, on the other hand, was oversubscribed to the tune of 110%. Western Carriers did get an oversubscription to the tune of 30-odd%, but the grey market for this one was rather volatile. At some stage, it was up 50%, and then, of course, went down all the way to a 5% uptick. But moving on to the primary action, we have with us Ajay Tyagi, Head of Equities of UTI Asset Management, joining in. Hi, Ajay. Good morning. Thanks for taking the time out to talk to us. It's Samina joining you from NDTV Profit. Ajay, just taking a cue from the sort of listing some of these primary market or newbies on D Street have got, what are your thoughts? Do you feel like with the amount of listing that we've been seeing in the last couple of months, potentially could be or has been the reason of liquidity getting squeezed out of the broader markets?
So yeah, good morning. I would say, liquidity is still abundant in the marketplace. We are seeing flows both by way of mutual funds, SIPs and lump sum. And the good news is that even FIs have turned positive now. So yeah, I mean, I don't think that there is any lack of liquidity, but at some stage, there would be fatigue that will catch up. The valuations for the markets have only been inching up. Of course, earnings growth has been coming, but at some stage, there will have to be a convergence between earnings multiple and earnings themselves. And I think that could be the reason for fatigue. Maybe we have started seeing that fatigue in a few sectors already. Some bit of liquidity is being channelized into new IPOs. Now that also at some stage reverses, because if the quality of these new IPOs is not up to the mark, which is only visible after a few quarters of listing, then you could see a lack of excitement on that side of the market as well. So in general, I would say that liquidity remains strong, but we can't take our eyeballs off valuations. Yeah.
Completely agree, Ajay. In fact, we've been complaining about valuations from the end of last year, and there's been no letting up in that sense. Just coming back to the IPO space before I move on to the secondary markets, do you feel like the IPO market, though, is in a bubble? I mean, the BSE SME IPO index has given 160% returns in the last year, and that comes in at a PE of 65. Every single IPO we've seen has been oversubscribed at least 100 times. Do you feel like the space is exploding and this could be a bit of a concern?
Yeah, without mincing words, I would say that it certainly is a cause of concern, especially the SME IPO market. I think that's the market where you hardly see any institutional participation. That's where, the retail part of the market gets completely agog. And without necessary checks and balances, things very easily go overboard there. And that's what we've been seeing right now. So SME IPO, clearly case for concern. As far as the main market is concerned, I would say, yeah, here also one needs to exercise caution. Now, there's a good part of this story and a bad part. The good part of the story is that, look, India is one of the very few markets where such kind of high quality IPOs keep coming by. The other day I was reading data around the UK markets, and it's a very sorry state there, because in the UK over the last 2-3 years, there have hardly been any IPOs, and therefore domestic investors are frustrated in terms of where to put in, incremental money. India, to that extent, is quite blessed. But see, there is a 80-20 Pareto law everywhere in life. And that's true for IPOs as well. So if you're getting 100 IPOs, please bear in mind that 80 of these IPOs will not create wealth for you in the fullness of time. They may give you listing gains, but they may not, essentially be those wealth creating companies. So you have to be extremely focused when you do research. And eventually, yes, some of these companies will turn out to be great businesses to hold. The onus of doing the right research and picking up these gems lies on the investor. So, yeah, I mean, good part is we have a very good funnel, but we have to still, distill that funnel and take out companies which are really worthy of, being held for the long term. Yeah.
Ajay, you started this conversation and we both concluded that valuations are stretched, but liquidity is in abundance. In that sort of a backdrop, do you see a low probability of a deeper correction in the equity markets in the coming quarters, even if earnings disappoint?
That's a very difficult question to answer. And with each passing year that I have spent in the markets, the one thing that I've learned is that, markets basically prove you wrong all the time. So, my 25 years of experience in the markets tells me that it's very, very difficult to forecast how this creature would behave over the next 6 to 12 months. You're absolutely right. If you would have asked me this question about are markets expensive, then exactly 12 months back, I would have said, yeah, they are expensive. And look here, we are sitting at this market which continues to make new highs every other month. But yes, our concerns really remain around valuation. The big picture remains solid. India is tracking well on most macroeconomic vectors. And, investment is also a bit of a relative game when India gets compared to many other, emerging markets around us, not just geographically, but in the same universe. India really stands out as one of those oases where you continue to see growth and, growth being steady for decades to come. So, yeah, there's a short term and the long term. I would say in the short term, the probability of a correction to our mind is higher. And please don't miss out on the fact that a bull market itself comprises of many corrections. So, this is nobody's case to say that in a 5-year or a 10-year bull market, you won't see corrections. I'm just reminded of this 2003 to 2010 bull market, where there were at least 3 very, very strong corrections along the way, while earnings growth remained strong. So to your point, if earnings growth surprises us on the positive side, does it mean that we would barely have a correction? I would say no, that wasn't the case in the previous super bull market that we saw. That hasn't been the case in global markets as well, whether in US or in Japan. Whenever things go a little overboard, it's, a correction is always lurking around the corner. Yeah.
Ajay, do you believe that focusing on quality over momentum may be a better strategy from here on? And I ask you this because one of the top performing funds in the recent past has been from your stable. The UTI Momentum has caught everyone by surprise. I mean, the outperformance has been significant. Do you feel that from now on, the bet should be on quality as opposed to momentum?
Yeah, again, that's a brilliant question. We've been grappling with this. And as I said in the previous question, it's almost impossible to time these things. So, you can only look at the data and figure out where are you in the cycle. And you can never actually forecast and say that, look, this is the turning point, and therefore we must switch the tap from on this one and open the tap on the other one. So that it never happens like that. But yes, the charts are telling us that we are very deep into the momentum cycle already. And at the same time, we are actually at a very, very initial stages of the quality cycle starting to look north. And if you look at data which goes all the way to 2005, because thankfully we do have data for the momentum factor, the value factor, and the quality factor from 2005, and we follow the cycles over the last 20 years, then the data is suggesting that we are certainly at the cusp of quality turning around and starting to surprise. At the same time, momentum actually going into a consolidation, taking a breather, perhaps even correcting. So yeah, I would agree with that analysis of yours. We too are reaching to the same conclusion.
It's a tough market for any fund manager to navigate right now. The other question on the same lines, there's so much of talk about moving to the large cap space, and you alluded to the fact that a lot of the FI money has started coming back. Now, part of it on Friday was largely on back of the rebalancing of the FTSE index, the World FTSE index. But that aside, if we do believe that we've borrowed returns from the future because the Nifty has been outperforming year to date, the idea that passive large cap would be enough to play that space may not stand. Do you think now is a good time to play the large cap space and do it through active fund managers? Because up until now, their performance wasn't even beating the benchmark.
Sure. See, in any market which is extremely polarized, you would find active fund managers finding it very difficult to beat the benchmark. So, let's take the case of the US markets as well. If there were those magnificent 7 stocks which were actually, surprising everyone month on month, both fundamentally and therefore in terms of their stock prices, it would have been well impossible for any fund manager running a diversified fund to beat the respective benchmarks. And so has been the case in India. The market has been fairly polarized. And, therefore, ability to beat the benchmark is very low. But, our view is that the markets may actually consolidate over the next 12 months. They may even see a correction. And it is during times like these that active fund managers basically have a higher ability and a higher probability to beat the benchmark. So, yeah, I would say that the next 12 months look to be loaded more in favor of active managers. The last 2-3 years have pretty much been the case of anything and everything going up. It would be much more selective from here on. I think a lot of these businesses which were badly beaten up in 2020 saw a very sharp fall from their respective abyss. That's gone. So that price movement, that very sharp price reversal and movement is now gone. From here on, like I mentioned earlier, it ought to be a convergence between earnings and valuation. And wherever managers are able to figure out businesses which would have a much better earnings profile over the coming years, I would say the rewards should ideally be waiting for them there. Yeah.
Ajay, there are 2 sectors, both global facing. Tech, usually in a lower rate cycle, tends to outperform. And it's also one sector that over the last decade has given investors positive returns. The last few weeks have been rough for IT stocks. On the contrary, metals, where fundamentally things are concerning, but just because the Fed cut rates in China today, of course, lowered rates and, pushed in some liquidity, metal stocks seem to be up and about. Also, the fact that LME inventory stands the record low. How do you play both these global-facing sectors? Do you buy into IT on reasonable valuations? Do you buy into metals despite weak fundamentals? What is the bias?
Sure. See, there is always this question of the very near term versus the longer term. Now, these 2 sectors that you mentioned, one of them, which is IT and tech, is basically a structural growth industry. I mean, we can keep debating for hours and hours together about how technology has shaped our lives, how technology has shaped businesses, how technology has basically, how technology from just being a cost-saving tool for corporates around the world has metamorphosed into a customer acquisition strategy. So now if 2 companies are wanting to win the battle and get the best customers and witness growth, then technology is a very big facet of this, because technology provides that interface. And if the interface is really great, then customers typically gravitate towards, these businesses. So I think technology is into structural growth. We started seeing the fruits of technology in the late 70s and 80s. It's continued for 4 decades, and I won't be surprised if it continues for another couple of decades at least. But yes, there will be cycles. Like you mentioned, there was a weak cycle in 2022 and 23. We may be getting into an up cycle right now. I'm sorry. And from that perspective, most IT companies look attractive. Of course, they are overvalued compared to the historical past, but the overall markets are at least 20 to 30% overvalued compared to the last 10-year history. So to that extent, the overvaluation for the IT sector is not that significant. The other one is metals. This is highly cyclical, of course, as we all know. And of course, in the near term, there could be an element of Fed rate cards. There could be an element of stimulus coming in from China. But if we all are of the opinion that global growth is slowing down, certainly in China and also in the US, even if US avoids a recession and goes into a soft landing, the growth in the US would be a fraction of what it was between 2021 to 23. Europe itself is showing no signs of strength in any case. So from that perspective, I'm wondering where would the demand-led pull come for this entire metal space. So outside of this technical factor, from a medium-term perspective, the picture is not really that rosy for the commodity space. Yeah.
Also, one space, and if it's more domestic facing, even though we aren't seeing too much activity in this space over the last few days, is consumption. Are you buying into the consumption cycle right now? Because there's so much that's happening for us. There's a general sense that earnings will also see an improvement from this quarter on. We're going into the festive season. Consumption a place you like? And if yes, what would the bet be? Would it be urban consumption? Would it be rural? Would it be aspirational? Would it be QSR? Any sort of biases there? And if whether you're constructive and overweight on it to begin with?
Absolutely, we are overweight on consumption. And let me make a very profound statement. You can't be positive on India and yet be negative on consumption. We are an economy which is driven by consumption. Almost 70% of our GDP comprises of domestic consumption. So you can't be positive on India structurally and say that, look, what I don't like about India is India's consumption. Yes, consumption goes through its own cycles. We've seen that high inflation of 2022 and 23 led to pressure on the wallets for most households in India. And because of that, yes, the discretionary part of the consumption got curtailed. It did spill over to some bit of non-discretionary consumption as well. But thankfully, inflation is coming down. We see better, real earnings and savings for households going forward. Therefore, consumption should pick up. That's point number one. As far as biases are concerned, I would say rather than rural or urban, we try to dissect the consumption space into consumer staples, consumer durables, and consumer services. It's our belief, looking at data, that consumer staples would be that part of the market which should actually see the most anemic growth in the coming not only year or two, but even beyond that, for the simple reason that the penetration in this category has already reached to a very high level. And beyond a point, you can't consume more shampoos or toothpaste or soaps and so on. So you can go on the premiumization curve there, but the volume-led penetration growth doesn't happen beyond the point. So India has already reached to a stage where the staples penetration is fairly good. But the penetration on the consumer durable side, which are many discretionary items that we use in the household, as well as consumer services, you were alluding to QSRs, which is a part of consumer services. I think this is where the consumer wallet will shift. This is where we will see households and consumers making incremental spending. And that's the part where the penetration, by the way, is very, very low, not only compared to the global averages, but even compared to emerging market averages. So I think that's the, if I may use the word, that's the predilection that we have within the consumer space. Yeah.
You know, Ajay, another way to play consumption and to play new energy is through the auto space or through the auto ancillary space. Again, we're going into the festive season. How do you feel the auto sector can be played? One, would you buy into auto companies? If yes, where would the biases be? Or would you just play the auto pack by simply playing the ANKs?
No, I mean, we would actually try and find out great businesses in all corners of the auto space. So it's not as if we are, at this stage, limited only to passenger cars, not to two-wheelers, or only to ancillaries, and not to OEs. So I think there are strong businesses in all quarters within auto. The good news about auto is that whether we look at passenger cars, whether we look at two-wheelers, and also at ancillaries, which are, by the way, supplying either to these domestic OEs or exporting I think there is immense scope in the coming years, and I would say beyond the next few years as well. So it's basically very linked. It's highly linked to the valuations within this sector. Parts of this sector have seen a massive valuation run up. So from a near-term perspective, we would be cautious on those. And some part of the sector has actually not participated as much, and valuations here are extremely comforting. While the markets are trading at, like I mentioned earlier, 30% higher than their last 10-year valuations. Within the auto space, there are a few players which are trading around their long-term valuation. So, yeah, I think our focus would be basically on such companies. But auto in general remains a fairly, I would say, longer-term, long runway industry opportunity. Yeah.
Ajay, you said if you want to play India, you cannot not play consumption. I would extend that further and say if you want to play India, you can't not play the financial sector. Now, so many different verticals to play the financial space, right? You can either go with banks, you can break the banks into private and PSU banks. You can then, of course, bring in asset management companies. You can bring in companies that are focusing on wealth, so maybe the Edelweisses of the world, betting on the financialization of the country's savings. What is your bias in financials? Where would your bias say? And if it's banks, then is it private versus public? And if it's outside the banks, then what are the obvious choices you'd make?
So yeah, that's a great question. And I would say this is one of those sectors where there are immense opportunities within. So we are playing financialization of savings on one side. We are also playing basically credit penetration. And this credit penetration is both on the household side as well as SMEs and even large corporates. And we are obviously, playing this theme wherein, these banks are financing the consumption which households are undergoing. Whether you're buying a big LED TV or a refrigerator, I mean, it's all getting financed. So I think the opportunity here itself is immense. Now, what's happened in the last few years is that, the plays which are related to the capital markets in one form or the other have seen a very sharp run-up, of course, because of very strong earnings growth over the last 3-4 years, and also because of a massive re-rating in their valuation multiple. So it's been on both accounts. Now, should earnings take a breather if, let's say, capital markets go sideways, for a few quarters or a couple of years, or they don't, have the kind of momentum that I've experienced in the last couple of years, then there would be, earnings slowdown, which will also lead to derating. So I think this is the part of the market where we would be cautious at this stage. It is still an opportunity in the fullness of time, but from a very near-term perspective, I think it's better to be cautious here because both earnings and valuation re-rating has been in their favor over the last few years. The exact opposite of this has been private sector banks, which have barely participated in the rally, and it really baffles most of us here, because we are really talking about some of the best managed institutions in this country. And I'm not saying best managed banks or NBFCs, I'm saying some of the best managed corporates in this country are pretty much, the companies which have not participated in the rally for the last 3 years. Of course, there have been near-term concerns, but there is no real longer-term, concern which should pull them back. So from that perspective, that's the segment we remain most positive on at this stage within banking and financial services. Yeah.
Ajay, in terms of a portfolio construct, and I know coming from an asset management company, you would be recommending individuals to follow a strict rule of SIPs or STPs, and we all agree that it's time in the markets, not timing the markets. But if I had to just, bring this down on a very pointed way, would you recommend investors to stay on the sidelines with incremental addition to the markets, hoping that there could be a better opportunity? Because you did indicate that you do see the year to be one of consolidation or maybe even some correction. So would it be wise to sit on some cash? And if yes, what quantum would you advise them to sit on in terms of percentage for an average risk profile investor?
Sure. So, see, that's a very, very difficult question to answer, to be honest. I did say that it's impossible to, figure out the direction of this creature over the near term. And therefore, to make any such kind of I would say, advise about how much cash to hold, how much to invest is always fraught with that risk of markets surprising you one way or the other. But all that we are saying right now is that, from a big picture perspective, this is not the time to be making lump sum investments. This is not the time to be actually feeling, having this feeling of missing out or having missed out the rally of the last 2 years and therefore now playing catch up by making one, big investment into the markets at this stage. So, for investors who have either missed out or investors who participated in this rally, going forward, at least for the next 12 months, the most rational thing to do is to make SIPs on a monthly basis. Should markets correct, you should be happy because your investments are being made at lower levels. Should markets refuse to correct and stay where they are or even inch up, at least you won't have that regret of staying outside of the market. So the only rational, and see, investing, as they all say, is majorly a behavioral science rather than, knowing, deep about your company. So it's your behavior which ought to be in the right place. So from a behavioral perspective, I think it's our advice to continue participating in the markets by way of SIPs. Yeah.
Ajay, one quick one on chemicals. There seems to be some sort of a rebound that's playing out, and after many years of underperformance, I mean, this was a sector that was a darling of the street for such a long time, right? And then came the overcapacity, then came the concerns on demand. But it feels like the situation may be improving. Are you bottom fishing in the chemical space? Are any of your fund managers optimistic on chemicals?
So without going into the specifics, I would say that the chemical industry did come out of, a massive, I'm not even sure whether it's come out completely, but has undergone a massive destocking over the last 2 years. And that's the reason why many chemical companies, I would say most chemical companies in India did face, growth pressures and also did face margin pressures. But we seem to be coming close to this destocking cycle. And at some stage, the industry will start to see restocking once again, which would mean that the growth engine starts for most of these chemical companies from India. So we too have been watching this cycle over the last couple of years. We seem more confident today compared to a couple of years back. We would be selective in this industry.
Right. Thank you very much, Ajay. We'd have loved to chat with you longer, but on to other news stories that we have to track. You have a good day, and we'll hopefully see you soon.
Thank you. Thank you. Good day too.
Yeah. On to an exclusive now. This is an NDTV Profit exclusive. Sources to Profit say that HDFC Bank is looking to sell 60 to 70,000 crore rupees worth of assets in the next few quarters. My colleague Vishwanathan Nair joins in with more details on this. Vishy, what are your sources saying? HDFC once again seeing some buying?
India's largest private sector lender, HDFC Bank, is looking to offload between 16 and 70,000 crore worth of loans from its balance sheet, primarily because the bank is looking to manage its elevated credit deposit ratio. Now, after the merger with HDFC Limited was concluded in July of 2023, the bank has been looking at ways to bring down the asset portion of its balance sheet because the liabilities currently are lagging and the credit deposit ratio is over 100%, 105% now for HDFC Bank. And this is not a sustainable position to be for a lender like HDFC Bank because that reduces the headroom available for the lender to keep growing its balance sheet. What is going to happen with these 60 to 70,000 crore worth of loans is that they will be part of either pass-through certificate or some other market instrument, which will then be sold to potential investors, which includes mutual funds and insurance companies. And this will free up liquidity for HDFC Bank. To make the deal sweeter, HDFC Bank is likely to offer about 40 to 50 basis points higher than the contracted rate of these loans, which will help the investors to come out and invest in these instruments and take these loans off of HDFC Bank's balance sheet. And thereby, the bank will be able to manage its credit deposit ratio. Alongside that, of course, the bank is continuing its push for deposits.
Well, thank you for that, Vishy. That was, of course, an NDTV Profit exclusive on HDFC Bank. With that, we're completely out of time on this edition of Talking Point. Thanks for watching.